Hey, everybody. Welcome back to another show. Had something on my mind. I want to talk about what we're really seeing real time inside of our business right now. And sometimes this is a no-on podcast to date them, but I'm recording this early March 2026. We've seen about 24 months, maybe a little longer, of hesitation, fear, and kind of a wait-and-see behavior from real estate investors. There was a mentality of, I want to invest, but things are crazy with tariffs, general unrest, interest rates. If I buy now, I might regret it in 2 years, right? Maybe prices go down and I'll have overpaid. I'm going to feel like a sucker, right? And that, it's a deer in the headlights kind of phenomenon. We're starting to see that change. Many investors are now viewing the market and interest rates as having stabilized. I listened to Logan Mohtashami of Housing Wire, his podcast. He puts it really well. I was listening to it the other day about when a grown person asks him, hey, should I buy a house? And his answer is, I don't know. You're a grown person. If you're asking me that, maybe you shouldn't. But his ultimate answer was, you are going to die one day, right? You're waking up tomorrow a day older. Time marches on, right? At some point, you got to do something if you want to preserve and grow your capital, right? And I think that that's kind of happening. People are going, hey, all this time has gone by. Prices have actually probably edged a little bit up in some cases. Interest rates are a little better than they were, 2 to 3 years ago. And that's why we're seeing more investor inquiries and we're having a lot more serious conversations now. More capital is getting ready to move. So I want to break that down. For the last few years, the biggest issue wasn't necessarily pricing. It was that uncertainty. Rates jumped fast. You remember how fast they went up? And the Fed was aggressively increasing the federal funds rate. Headlines were negative. We need some big adjustment in cap rates, which we have had to a degree. Everybody was kind of waiting for that crash, that mentality of, I missed it in 08, but this time I'm going to get it right. I'm going to know exactly when the bottom is. And when investors feel uncertain, they freeze. And what's changing right now is not necessarily the rate environment, although it is down. It's psychology. People are calming down. They're realizing that rates are probably not going back to 3%. But the world didn't end. Rents didn't completely collapse. And good markets are still growing. And sitting in cash has a cost. And most importantly, people still need a place to live. And it generally feels like we're moving from uncertainty to kind of a stability. So here's what we're seeing on the ground. Increasingly, investors are accepting that if a deal makes sense today and it's in a landlord-friendly market with a growing population and low unemployment rate, then it'll make even more sense 5 years from now. A while back, I did an episode on rates, and the case I made was that if you invest in a deal that makes sense today, you're probably going to be sitting in one of these three places 5 years from now, assuming you invested in a deal that made sense today in a landlord-friendly market with a low unemployment rate and a growing population. By the way, it's hard to not have all three of those together. Number one, interest rates remain flat. If that happens, you're glad you invested. Your money's been at work for the last 5 years. Like Logan said, you're going to die one day, so at least you made some progress. And so your money's been at work for the last 5 years. Your principal has been getting paid down. You got some tax benefits and cash flow. You probably picked up some appreciation along the way too. Right? That's an okay situation. Second scenario, interest rates go up. If that happens, you're definitely glad you locked in that lower cost 30-year fixed rate debt and your money was still at work for you over those last 5 years, right? Number three, interest rates go down. If that happens, refinance, improve your cash flow. When people talk about interest rates collapsing, we really like the thought of those lower rates, but you do have to be careful what you wish for. A collapse in interest rates probably means a fair amount of chaos elsewhere. And we want to be fair on the show. If values decline a lot, it can complicate this. But when you enter a deal with 20 to 30% down, you have a great buffer. And we can zoom in tight enough, we can justify any investment narrative we want to either way. If we zoom into a really tight time frame, I can find whatever story I want to believe. But when we zoom out on a big enough of a time frame in a market with good fundamentals, we're generally going to win. So this warming market is healthier in 2021. Why? Because the deals have to pencil. I remember 2021. That was FOMO, fear of missing out. A lot of people just saying, I got to do this. This is ripping upwards. It's not like that now. Deals have to pencil. Investors are underwriting properly. Cap rates are more realistic. And builders aren't assuming endless appreciation. Buyers are really focused on that fundamental cash flow again, and the froth is gone. What's left are really disciplined investors. People who have recentered on fundamentals of good real estate investing. And historically, the best vintages of real estate happen right after fear peaks, not during euphoria. When everyone was overconfident, yields were compressed. Making a great investment decision rarely feels like it in the moment, especially when the media is awash in hysteria, which seems like standard protocol for them now. I mean, they got to sell that ad space, right? So hysteria sells ads. So why are we seeing more inquiries specifically? A few reasons. Investors have been sitting on the sidelines for almost 2 years. Cash is piled up. I read the other day that there are many trillions of dollars in money market accounts right now. And people begin to realize that inflation quietly erodes idle money. Stocks also feel expensive to many investors. The tech boom feels a little toppy, like it's backed off some. There's a growing belief that the Fed's going to continue to ease and that treasury volatility is compressing. Even if rates don't drop dramatically, stability alone builds confidence, and we've seen that in mortgage rates. So markets don't need perfection, they need some predictability. So if you're an investor listening to this, here's the shift I'd encourage. Stop trying to time the bottom. Instead ask, does this deal cash flow today? Is it in a growing metropolitan area? Are jobs and population expanding? Can I hold this through cycles? Does it make sense over a 5 to 10 year time horizon? Because real estate's not a 6-month trade, it's a long-term wealth-building vehicle. And investors who move during cautious optimism, not peak hype, tend to do well. So yeah, from where we sit, the market's warming up. I've seen more inquiries and investments happen over the last few months than probably the last few years. My favorite part about that, though, is it's coming from cash flow-oriented, fundamentally sound investors, not from hype and hysteria. So if you want to talk through what makes sense in today's market, reach out to us. We're underwriting deals every week. There's opportunities if you know where to look. Thanks for listening, and we'll see you on the next episode.